Everyone is talking about recession. Banks are warning, markets are shaking, and people are more confused than ever. Is the US economy heading toward another major downturn? Everyone is a pessimist these days. On July 14th, Steven Blitz of TS Lombard, an investment research firm, said that he was now expecting a recession this year in the world's largest economy. A day after Bank of America made the same call, Goldman Sachs, another bank, expects GDP in the Eurozone to fall in both the third and fourth quarters of the year. Americans have never been so high. Traders are selling copper, buying the dollar, and pricing in interest rate cuts in 2023. A number of factors have combined to create a toxic mixture. In response to the COVID-19 pandemic, America overstimulated its economy, provoking inflation not just within its borders, but beyond them, as consumers' voracious demand for goods bunged up the world's supply chains. China's attempts to stamp out COVID compounded these problems. Then Russia's invasion of Ukraine caused commodity prices to soar. In response to the ensuing inflation, roughly 4/5 of central banks worldwide have raised interest rates by an average of 1.5 percentage points. After a meeting that ended on July 27th, the Federal Reserve raised rates for the fourth time this cycle, by 3/4 of a point. At the root of recession worries is a fear of the consequences of monetary tightening. It is clear that central banks have to take the proverbial punch bowl away from the party. Wage growth in the rich world is far too strong. Given weak productivity growth, inflation is too high. But the risk is that higher rates will end the party altogether, rather than making it less raucous. History is not encouraging in this regard. Since 1955, there have been 3 periods when rates in America rose as much as they are expected to this year. In 1973, 1979, and 1981. In each case, a recession followed within 6 months. Has recessions struck again? Rich world economies, which account for 60% of global GDP, have certainly slowed since the heady days of mid-2021. When COVID restrictions were being lifted, Goldman Sachs produces a current activity indicator, a high-frequency measure of economic health based on a range of indicators. The gauge has slowed in recent weeks. See Chart 1. Surveys of factory bosses in America and the Eurozone by S&P Global, a data provider, suggests that manufacturers are gloomier than at any time since the early days of the pandemic. It looks too soon, though, to declare a recession, even if, as some expect, statisticians reveal after we go to press on July 28th that between April and June, American GDP contracted for the second quarter. This would count as a recession by one rule of thumb. A series of oddities led GDP to shrink in the first quarter, even though the underlying performance of the economy was strong. Most economists look to America's National Bureau of Economic Research, NBER, to find out if the economy is truly in recession. Its Business Cycle Dating Committee considers indicators beyond GDP in making that judgment, including jobs numbers and industrial production. The Economist has used a similar approach, with a little guesswork, for the rich world as a whole. Many indicators still point to expansion. See Chart 2. It is hard to argue that a recession has arrived. Yet with growth clearly slowing, the big question is how bad things will get. The few remaining optimists point to the strength of households and firms. The public is even gloomier about the economy than it was during the depths of both the global financial crisis and the pandemic. See Chart 3. But households in the rich world probably still have some $3 trillion or so in excess savings accumulated during the pandemic. In America, The cash balances of poor households were 70% higher in March than they were in 2019, according to the J.P. Morgan Chase Institute, a bank-affiliated think tank.
Thanks for watching. If you want more powerful economic breakdowns, subscribe to the Economy Boss. See you in the next video.